Hello, friends. I have been warning you against investing in interest rate sensitive stocks and sectors since over a few quarters. If you're connected with me on social media, I've been telling you I'm worried about banks. Now, I'm going to talk about why US banks, and there are six reasons of them, not just one, six main reasons. There are many smaller ones, but six main reasons why US banks appear to be weak and they might just drag the global banking space down with the sheer nervousness. Fear is contagious, and out of greed and fear is always magnified in its by its impact on asset prices in financial markets. So it's always important to understand what is going to impact the price of any investment that you are making. Now, friends, item number one, US credit card debt. Now, basically, credit card debt is unsecured debt. The bank or the NBFC that is issuing the credit card is taking a massive risk that the credit card holder may or may not make payments on time. Now, to compensate for this humongous amount of risk that they are taking, they charge you an obscenely high rate of interest. It can go, as per Statista's website, from 23.5% to 24.1% APR, annual percentage rate. That's pretty steep for US. In India, it is much more higher. Now, what is the kind of outstanding that the US credit card industry is witnessing? First of all, it's at a record high. Secondly, the figure is a staggering $986 billion, and this figure is a couple of months old. We are still to get the figures for the end of March because March is an ongoing month. Now, as inflation goes up, as interest rates go up, it becomes more and more difficult for any borrower to pay his EMIs and or revolver credit, which is a minimum percentage amount that you have to pay every month on your credit card outstanding. And therefore, delinquencies tend to rise. Now, in banking, delinquencies is a very polite, sophisticated word for default. So, defaults tend to rise in rising interest rate scenarios. So, this is factor number one. Factor number two, student loans. Now, these are taken by 43 million borrowers in the US and they constitute a big amount of the total household debt of an average US household. Now, if employment markets were to turn hostile, which means new graduates find it difficult to get well-paying jobs comparable to their educational qualification, repayments on these loans can also turn pretty delinquent. What is the size of this market? Hold your breath. 1.6 trillion US dollars. And what about the rate of interest? The US federal rate, which is of course subsidized and discounted, is 4.99% annual percentage rate, whereas the private sector loans can start from 7.25% and go all the way up to 12.29%. The problem is your credit rating. If you have a weak credit rating, you have to pay a penal interest rate, which is higher than the Fed rate. Now, with a loan book size of $1.6 trillion and an economy that threatens to go into a soft or hard landing, another polite word for recession, you seriously have a problem. Pressure number three, housing loan market with an annual percentage rate of 6.95% on FMR, fixed mortgage rate of interest. Now, this market is $11.5 trillion, and this data is slightly dated. Now, if property prices were to come down, what we have learned from the past crisis of 2008 and that was a global financial crisis triggered by the housing market prices in the US. Supposing you were to buy a house of 1 crore rupees. In the US, it is not difficult to get 100% funding. So if you were to take a house of 1 crore, get a bank loan of 1 crore on which you're paying an interest rate, which is the annual percentage rate of 6.95%. Suddenly, if the house value was to go down to 90 lakhs, not only are you losing 10 lakh rupees in capital immediately, but you're also paying interest on the previously higher amount of 1 crore. So it actually makes more sense for you to default. And this is what an average Joe in the US does. So there are $11.5 trillion of outstanding housing loans in the market, which the US banks rather in plural, must be worried about. I would not want to be a bank manager in the United States as of now. Item number 4, auto loans. Now here again, your interest rates can vary from 3.84% all the way up to 15.86%. Why? For God's sake, it will depend on your credit score. In the US, you can very with great difficulty walk into a car showroom and get out without buying a car. They hard sell. They force you to buy a car. Bad credit score, no problems. Just sign the paperwork and we'll give you the keys to the car. Why? Because we'll charge you higher rates of interest. Now, this is greed at its best. I've heard stories as a child in school. In America, poor people own cars. It's such a good and rich country. Now, this is a problem. You've been charging interest rates of up to 15.86% on people who are possible defaulters because they have weak personal credit scores. The size of this market, $1.55 trillion, and as again, the data is slightly outdated. But if you Google search US car loan defaults or US car loan delinquencies, you will see that the number of outstanding EMIs that are over 30 days old has suddenly gone up. Here is pressure point number 4. Now, pressure point number 5. Junk bonds. What are junk bonds? Now, this is something that I have been constantly worrying about, and I have been commenting on my social media accounts, Twitter, Facebook, LinkedIn, YouTube, etc. Junk bonds are no more called junk bonds after Michael Milken turned the market topsy-turvy. Right? Now, they are very politely called high yield bonds. Why are they high yield? In India, we know when we invest money that there are two aspects to money. One is the return on capital, which is the interest. The other is return of capital, which is the principal. Now, high yield bonds, or what I would in very stark, naked language call junk bonds, are very poorly rated or credit rated bonds, if at all they are rated. Now, they are ideally below BBB rating by Standards and Poor's and or Fitch. These are two rating agencies. Or they are rated at or below Baa3 by Moody's. All right. Now, why do people invest in junk bonds and poorly rated bonds? This is something that I have been tweeting about since at least 2001. The reason is alpha. The mad chase to generate profits whether markets are bullish or bearish. This is something that hedge fund managers have been pushed into doing because the US has been printing unbacked currency and flooding that currency into the market, and that money has to be invested somewhere. So some bizarre things have happened in the last 2.5 years. Lumber went up over 600%. Now, what is lumber? Cut trees, and that wood is used to make furniture. Lumber went up over 600% in a year. You think the number of forests went down? No, they didn't. It was just greed. Now, that is why greed propelled the mad chase to alpha or absolute returns. And I have been telling you that a beautiful measure called the Jensen's measure and the Traynor ratio are something that every hedge fund manager or an aspiring hedge fund manager should live by. Now, these are metrics that tell you whether taking one additional unit of risk is yielding at least, if not higher, 2 units of returns. That is when taking the additional unit of risk is worth it. But when I analyze what the junk bond market was doing, people were investing in junk bonds at very hostile readings of the Jensen's measure and the Traynor ratio. And the size of this market, $2 trillion and counting. Now that interest rates are rising, people are realizing, hey, why invest in a poorly rated security which is yielding higher rates of returns when you can invest in very well, highly rated industries and very well, highly rated government bonds and private bonds? So, as a result of which, take a look at the chart on your screen. This is the index of the high yielding bonds, and this has collapsed since October 2021. It's persistently come down gradually in the beginning, but is gaining momentum. So what does it tell you? It tells you that people are realizing their mistake and pulling money out. When they pull money out, the structure is likely to fall. Now, the sixth piece of pressure that is likely to impact banking in the US. Investments in third world countries is sovereign debt, even though the sovereign rating was not all that great. If you go through the last 2 years of my Twitter feed or LinkedIn feed or Facebook feed, you will see how I've been worrying about countries as weak in their balance sheets as Peru, Dominican Republic, South Africa, Chile, etc., attracting money for just one reason alone. And that reason is higher rates of interest. Argentina, higher rates of interest. Hey, remember return on capital and return off capital? The guy who's paying you higher return on capital may not return your capital. Now, this market is the biggest of them all because there is a presumed or a perceived mythical sovereign guarantee. Because you assume that a government will not default, and veteran traders like me, I've been trading these markets since 1986, and in 1997-98, I learned bitter lessons in the Southeast Asian currency crisis. Yes, sovereign defaults can occur. Look at Mexico, look at Russia, look at all these countries known as tiger economies in Asia, Indonesia, Malaysia. They almost all went under even though the bonds were sovereign rated. Look at Italy in 2012. Look at Portugal. Look at Greece. Look at Spain. They've all almost gone under in spite of being sovereign rated. So this is another pressure point. This is one reason why I always include bonds in my weekly market outlook videos, because bond markets lead the equity markets and not the other way around. Most of you sometimes tell me, hey Vijay, are you a pessimist? Are you a bear? Look, I run an incorporated limited company that invests in the stocks and assets floated by other companies. When I'm entrusting my money and putting it into somebody else's company who may or may not run the company as well I would want him to, I have to be an optimist, which is why I'm investing in somebody else. I'm not an out and out bear, but I also don't snort hopium. It's the job of people like me who incorporate companies to put their money in the line of fire. Why? Why do take a risk? Take a risk for the reward of a profit. And to be able to earn a profit, you have to be a hardcore practical realist, not a perma bull. So I'm not a perma bear. I'm not a pessimist. I'm a rational, practical realist, which is why I've been telling you that there is no super cycle in energy prices. There is no super cycle in industrial metals. You are safer off in bullion, in gold and silver, and it might take a little longer than what I thought it would in seeing these prices go up. They've gone significantly higher from what I recommended them at in 2020. Admittedly, gold has not gone to 65,000 rupees per 10 grams and silver has not gone to 85,000 rupees per kilo, but they are significantly higher than where they were recommended 2 years ago, and you're much safer off from them. Now, now that you know the problem exists and the problem is just beginning. In the US, banking problem is just beginning. What do you do about it? Hey, I've been telling you the way forward both as a tactical and a strategic trader. Tactical is short term, maybe even intraday. Strategic is swing. You carry your trade forward from one day to the other. I have been telling you I will avoid buying interest rate sensitive stocks, NBFCs, banks, companies whose sales primarily depend on EMI based selling. These are not going to do too well in the coming months, quarters, maybe longer. We'll, time will tell. Let's not form too long term opinions because we live day by day, week by week, and month by month as traders. But it's time to be extremely cautious. What should you do? I think you should bet on theta decay. That's the beautiful thing you can do out here. The market actually pays you to bet that these stocks will not rise much, even if you go wrong. So, theta decay with a yield of anything over 21% per annum is okay by me. That's beautiful. Higher, I'll take it. Sure, I'll take it. I would also take fat tail risk hedges on the forex markets. This is something that I have been telling you since the last 3 weeks in my weekly videos. I think there could be turmoil in third world emerging market currencies, and I remain very, very cautious on 4 sectors of the globe. And this is something you can verify from my YouTube, Twitter, LinkedIn, Facebook accounts, etc. Latin America or LATAM, Middle East, North Africa, MENA, Asia Pacific, APAC, and Southeast Asia. Southeast Asia is very close to home. We are in Asia, although not exactly in Southeast, but anything that happens here directly concerns India almost immediately. Forewarned is forearmed. Treat this video as a warning, and let's not be too pessimistic. A logical mind, a thoughtful mind knows that if there is a problem, using mathematics and statistics with logic, a solution can be found. On my Telegram channel, I share a lot of posts about how to do tick by tick analysis using Microsoft Excel by downloading data from your trading terminal, how to read the snapcode window on your mobile or your computer trading terminal. I share a lot of free studies on a free Telegram channel. So, if at all I can help my online family become better traders, that's a good thing to do. Let's keep it real. Let's keep smelling the coffee at all times and stay on high alert. Thank you for your patience in this video. This is Vijay Bhambwani signing off for now. Have a profitable day ahead. Bye-bye.